There is a market worth $1.7 trillion that most investors have never considered. It has outperformed the S&P 500 over the last 25 years. It is almost entirely invisible to retail investors. And the world's wealthiest families have been allocating to it for generations. That market is art. Welcome back to Capital Above Convention. I'm going to show you how the global art market actually works. Not the gallery openings and auction glamour you see on television, but the mechanics, the returns, the risks, and the structures that serious investors use to get exposure to one of the oldest alternative asset classes in the world. This is not about buying art because you like it. This is about understanding why a Basquiat painting that sold for $5,000 in 1982 sold for $110 million in 2017, and what that tells us about art as a financial instrument. Let's get into it. The global art market generates approximately $65 billion in sales every year. That number has grown consistently for 2 decades, with only 2 meaningful corrections. In 2009, following the financial crisis, and briefly in 2020 before rebounding sharply. The market is dominated by 3 cities, New York, London, and Hong Kong, which together account for roughly 80% of global auction sales. At the top of the market sit the blue chip names Picasso, Basquiat, Koons, Hearst, Warhol. These are the artists whose works trade like commodities among the ultra-wealthy. A Picasso is not just a painting, it is a liquid store of value that can be bought at Sotheby's in New York on a Tuesday and sold at Christie's in London 6 months later. But how does art actually generate returns? There are 3 mechanisms. The first is pure price appreciation. Art is a scarce asset. There is a finite number of works by any given artist, and that supply only decreases over time as pieces enter permanent museum collections. When demand from a growing global ultra-wealthy population chases a shrinking supply of blue-chip works, prices rise. This is simple economics applied to cultural objects. The second mechanism is the death premium, morbid but real. When a major artist dies, their body of work is permanently fixed. No new supply will ever enter the market. Historically, the works of recently deceased artists appreciate significantly in the years following their death as collectors and institutions race to acquire what remains available. This is a well-documented pattern across art market history. The third mechanism is the passion premium. Art is one of the few assets that generates what economists call dual utility. It appreciates financially while simultaneously providing aesthetic enjoyment. This means buyers are willing to pay more than pure financial logic would suggest. And the excess willingness to pay creates a structural flaw under prices at the top of the market. Taken together, these 3 mechanisms have produced average annual returns of approximately 8 to 9% for blue chip contemporary art over the past 25 years, according to the Art Price Global Index. That compares favorably to real estate, bonds, and even equities on a risk-adjusted basis, particularly given art's near zero correlation to public markets. Now let's talk about the risks, because there are real ones, and anyone telling you otherwise is selling something. The first risk is liquidity. Art is not a stock. You cannot sell a Basquiat in 5 minutes. A major auction sale requires months of preparation, cataloging, and marketing. In a forced sale situation, you will almost certainly sell below market value. This is the illiquidity premium in reverse. The same feature that generates excess returns in normal conditions becomes a liability in distressed ones. The second risk is authentication and provenance. The art market has a centuries-long history of forgery. A painting is only worth what it is certified to be. Provenance, the documented history of ownership, is everything. Buying art without impeccable provenance documentation is speculation, not investment. The due diligence required is significant. The third risk is taste and trend. Art markets are subject to cultural cycles. An artist who commands $10 million today may command $1 million in 20 years if their cultural relevance fades. The safest investments are in artists with established institutional validation. Museum retrospectives, major critical recognition, consistent auction records across decades. Understanding these risks is not a reason to avoid art as an asset class. It's a reason to approach it with the same rigor you would apply to any private market investment. So how do serious investors actually get exposure to art? The traditional route is direct acquisition. You buy the work, you store it, you insure it, you eventually sell it. This requires significant capital, but blue chip works start at hundreds of thousands and quickly reach tens of millions, and significant expertise in authentication, storage, and market timing. This is the domain of family offices and ultra-high net worth individuals with dedicated art advisory teams. The second route is through art funds. These are private investment vehicles that pool capital to acquire diversified portfolios of works managed by professional art market experts. They operate similarly to private equity funds with management fees, carried interest, and defined investment horizons. Access has historically required significant minimum commitments. The third route, and the most significant development in the democratization of art investing, is fractional ownership platforms. Companies like Masterworks have pioneered a model where individual investors can buy shares in blue chip artworks for as little as a few $100s. The platform acquires a work, securitizes it, and allows investors to buy and sell shares on a secondary market. Returns are realized when the work is sold. This model has fundamentally changed who can access art as an investment. The illiquidity and capital barriers that made art the exclusive preserve of the ultra-wealthy are being systematically dismantled. And the investor who understands this shift early is the investor who benefits most. The art market is not going anywhere. It is getting larger, more global, and more accessible. The question is not whether art belongs in a sophisticated portfolio. The question is how you get exposure before the rest of the market catches up. Subscribe to Capital Above Convention for weekly deep dives into the alternative assets that serious investors use to build and protect wealth. And I'll see you in the next one.